There we go. Credit management for SMEs, enhancing financial stability and growth, presented by Linda Rossouw and Frank Knight. Of Linda Rossouw of Archer Inspiration and Frank Knight of Dead Source. So our table of content today then, the introductions, and we're going to move, into formal introductions just after this. I'll give a little bit of an overview. We'll look at the definition of credit management today, the purpose of credit management, what is trade credit management not, the key objectives of credit management, the components of credit management best practices for SMEs, the conclusion, and questions and answers. So let me then introduce Frank Knight to all our participants today and everybody that is logged in. It is my great pleasure to introduce him, and we can read on the screen that he's the co-founder of a commercial credit information bureau known as Commercial Information Agency in 1990. And over the years, the business has gained significant market share through the implementation of innovation and technology advanced systems. And in 2000, the company was bought by TransUnion, where Frank was appointed to the board as e-commerce director. During his time in the credit bureau industry, Frank met literally with hundreds of credit professionals across many industries. And this laid the platform for his eventual entrance into the outsourced credit management business at the beginning of 2003, when he founded Dead Source Pty Limited, where he serves as the CEO. Frank is often consultant for press releases, publications, and books on matters relating to credit management, and he received the Alba Crutzner Award in 2007 for his contribution to the South African credit managed community. He was voted a fellow member of the Institute of Credit Management in 2009. So Frank, thank you very, very much for joining us today and taking the time to share your knowledge and experience with us regarding credit management.
Pleasure, Linda. It's a real pleasure to be with you today, and thank you so much for the invite.
Thank you. So, would you like to introduce?
Yeah, maybe just to then introduce Linda to you, seeing that she's been doing all the talking up to now. So Linda is the founder and the CEO of a company called Relevance Consulting, which forms part of the Archer Inspirations coaching team. And I see there's a couple of members of Archer Inspirations Coaching which has joined us this morning. Thank you very much and welcome to you. I think Linda will be introducing them in a moment as well. So Linda has 30 years experience in a number of different industries: retail, distribution, warehousing, customized interventions and solutions in a very unique manner for all the clients. In fact, I met Linda for the first time. She became a client of Dead Source. She was working as the CFO for one of our still existing customers. And I was really impressed with Linda's fantastic attitude. She definitely is an accounting type, but she's not a pinstripe suit accountant. And I think what always amazed me about Linda is her openness to new ideas, her willingness to share knowledge, and also a really deep-seated understanding of what makes businesses work. I think the last little piece that we've got here on Linda's bio really does say it all. She helps men and women to find their voice and unlock their true value and potential. And if you think about that, that is really what leadership coaching more than anything is about. In our business, we now employ about 130 people and work for probably about 1,200 clients. Within the bigger group that we operate in, we probably employ about 450 people. And actually, the thing that I've discovered, as I'm sure that many of you have discovered within your own businesses, is that it's all about the people stuff. If you get the right people, if you can train them, if you can coach them in the right way, that really does make all the difference. So thank you so much for the invite, Linda, and a beautiful bio.
Thank you very much, Frank. And yes, then just to add on to what Frank has said, I didn't want to, take the conversation to the front. And but yes, we've met a few years ago, and thank you very much for that accusation, Frank. But I want to say it's very mutual. I mean, the mutual respect of knowledge share, of Frank's willingness to share. I mean, today is a perfect example of his willingness to absolutely come and share his experiences and really, empower people about credit management, because there's such a lot of uncertainty about what is credit management really. And we do hope that when we go through our session today, that we will actually unpack all of that, and that you will have a far better understanding of what credit management is, whether you're a big business, because often people think credit management is just for big corporates. No, credit management is even for the smaller businesses and for medium-sized businesses. So I'll then go ahead now and introduce our team, and I'm going to allow each of the team to introduce themselves, and we'll start with Kenny, who is the founder and CEO of this amazing coaching platform called Archer Inspirations. Kenny, over to you.
What else do I need to say, Linda? You just said it. Everybody needs a little bit of something to help their business get somewhere, and we just created this company just to help those find a way and to be there for them to get there. And creating this dream of coaching company, it's becoming more and more of a reality every day. And that's me. Thanks, Linda.
Thank you, Kenny. Cherise, please introduce yourself.
Good morning, everyone. I'm Cherise. I am a business coach at Archer Inspirations. My passion is helping those who have a side hustle or a passion that they're currently trying to turn into a successful business. And I'm just really thankful to be part of this today. Thank you for the invite, Linda, and I look forward to learning quite a bit today.
Thank you, Cherise. Gabby, the floor is yours.
Thank you so much, Linda. I really appreciate this invite. It's been amazing. So I'm Gabby, a personal success coach, where it's working to make life happen for you instead of to you. So bringing the personal side into what your business could look like and individually. So yes, that is me, and thank you so much for having me.
It's a pleasure, Gabby. Thank you so much. Oops, Marissa hasn't joined us. Grant is our newest member to the team. So thank you very much, Grant, for joining. And please go ahead and introduce yourself.
Just unmute.
Thanks very much, Linda. It's good to be here. And I'm probably, as you say, I'm the newest member of the team. My passion is business. My passion is numbers. And often with small businesses and medium-sized businesses, you feel like you're kind of fighting the battle on your own. And it's great to be able to go along with people, hold their hands, and make them realize that it's actually just a big adventure, and that there's a lot of fun and a lot of fulfillment that can come from running a business. So that's what I hope to do.
Thank you so much, Grant. So before we then go ahead and actually, Kenny, did we swap the slides around? Okay, no problem. We'll work with the slides as they is. I think somewhere there might have been a little bit of a mix-up, but be it as it may. Let me then please, just tell you a little bit about Archer Inspirations. It is a coaching company, and of course, my role in Archer Inspiration is the business and finance coach, and I also obviously help Kenny with leadership coaching. And Archer Inspirations helps you envision your dream with a plan, keeps you inspired on your journey, and ensure you achieve what you are set out to do. Our passion is really helping business owners and leaders, both inspiring and established, who are highly skilled at what they do, yet find themselves and their team stuck. And often we find that, whether we in corporate, whether we, doesn't matter what industry we are often find, that we are stuck in our role, stuck in our personal life, and we don't know where to go. And that is where the beauty of coaches, can really help you to move forward. Archer Inspirations then give you that accountability, that guidance, feedback, and the inspiration you need to achieve your goals. We have taken everything you know about business, finance, and executive coaching and flip it on its head and really made it a company where you can come to with comfort and know you're going to walk away really being the best version of yourself that you could possibly be. Don't let inaccessible traditional executive coaching prevent you from getting the help you need. Whatever challenge you're facing, our coaches have been there, done that, and have the personal expertise, skills, and knowledge to the table to guide you on your journey to success. And now we'll let Frank tell us a little bit more about that source. Please, Frank.
Thank you so much, Linda. As you can see on the slide, we started the business back in 2003, so about 21 years that we've been going. You'll know from the Malcolm Gladwell book, I think it's called Outliers. He says that when you've done something for 10,000 hours, that you have become proficient at it. So if my calculation is correct, then about 20 years would be about 30,000 hours. So I think we've become proficient at it. The most important part about credit management that people don't get, and think not only about credit management, but think about credit risk solutions, is that if you want to fix a business from a financial perspective specifically, if you want to grow turnover, if you want to improve profitability, and if you want to manage your risks effectively, that is all going to be based on building a client base, customers, which are quality customers. The science of credit management says that a company's liquidity is directly related to the quality of its debtors book. So quality doesn't necessarily mean selling to the biggest debtors you can find, because even though you may think it's a quality debtor, and even though they may be minimal risk, the problem is if they're going to pay you at 120 days because they're a big company and they can, that's not necessarily going to help you achieve your cash flow goals. And so what we've seen over the past 20 years is when you implement effective credit management solutions, it really helps customers boost their turnover, improve their profitability, and definitely help on the risk management as well as on the corporate governance stuff, which has become ever so more important. In a couple of minutes' time, I'm going to show you kind of what the debt source business model looks like, so what we get involved with and what we don't, I think, also get involved in. But that, I think, gives you a good synopsis of what it is that we're trying to achieve at debt source.
Thank you so much, Frank. And yeah, I'm also really looking forward to the later session of today. So now it's your turn. Our participants that has joined our course today, and I would go around, the room, and if you could please introduce yourself, or you could have put it in the chat, your name, your business, and what do you hope to get out of today. And let me just see on my screen. Ronel, could we please start with you? Ronel, are you still there? Okay. Priya, are you comfortable to share?
Hello, yes, I am. My name is Priya Pegu. I'm currently the boss at BPS. I just want to get a different insight into debt management, how to manage debt, to learn a little bit more from other people's experiences.
Thank you so much, Priya. Fatima? Fatima, are you going to share? We'll come back to Fatima. And kindly introduce yourself. You must put yourself on mute and unmute yourself.
I've got the computer and my phone on.
No problem.
Can you hear me now?
Yes, yes, we can.
Good morning. I'm Anne. My company is AB2 Bookkeeping Services, and I'd like to provide the small businessman with a professional set of books for those that really don't need a full-time bookkeeper on their books. Thank you.
Thank you very much, Anne. Debbie, please go ahead and introduce yourself.
Hi everyone, I'm Debbie and I own a company called Show Travel 24/7. And yes, I'm interested in learning what Linda's got to say today. Obviously, being in the travel industry, we went through a very bad patch for a number of years with COVID. So yes, building up our cash flow and things like that is very important to me at the moment.
Thank you so much, Debbie. Desiree, please go ahead and introduce yourself.
Good morning, everybody. I'm Desiree from Estate File Preparation, and what I do is I help adults get the important information all collated into one place, so if they should unexpectedly pass away, everything is ready for their loved ones to take over and run their estate. Saves them a lot of trauma. What do I hope to get out of today? Well, as a coach, I get my clients to pay me upfront, so I don't have anybody that ever owes me money. But I think it's a very important topic, especially in today's economy. And so I'm here to learn all about credit management. Thank you.
Wonderful. Thank you very much, Desiree. Narasha, are you ready to share?
Yes, hi, I'm Narasha, the bursar at Bowley College, and I'm listening in just to get some invaluable information, learn something new today.
Thank you so much, Narasha. Pratima, are you ready now to share? No? And then please forgive me if I get this name wrong, but I'm going to try and pronounce it the best I can, like I see it on the screen. Bisopa. Bisopa, would you like to share? No? Okay. I think then let us then start and officially start our very, very interesting journey about credit management, and we're going to blow your socks off. Let's start.
Thank you so much
And
for
over
that.
to you, Frank.
Yeah, thank you so much, Linda. Really appreciate that. So yeah, just as a definition of credit management for those of you who just kind of want to understand the 5,000-foot view of what credit extension really is all about. It's really the process of strategically managing and controlling credit and financial risks associated to credit granting to customers. It incorporates the assessing the creditworthiness of customers, implementing policies and procedures to ensure timely payment, minimize bad debts, and optimize cash flow. I think maybe the way to explain credit management to you is to say to you, let's all assume that we get together in a business and that tomorrow what we're going to do is we are going to start importing laptops from China, and we are going to sell these to companies all over South Africa. So what we do is we go to China, we find the best possible supplier of laptops, we ship them to South Africa. We've got this beautiful warehouse and all these beautiful laptops lined up. Our very first customer walks in and says, "Oh, I really like your laptops. These are absolutely amazing. Please, can I buy 1,000 from you? And by the way, can I pay you in 60 days' time?" So that all of a sudden we get very excited about the turnover. We're like, yes, we're finally selling laptops. And then we stop and say, but what if this customer doesn't pay us in 60 days' time? So now what we do is we start thinking to ourselves, okay, well, what should be the process here? The first is, do we know this customer? And so, yeah, we probably need some information on this customer. The second question that we may have to ask ourselves is, should we be selling this customer 1,000 laptops, or can he really only afford 100 laptops? So that's what we call a credit limit, a credit facility, if you want. The next question we ask ourselves is, can we insure this transaction? In other words, if this customer doesn't pay, does it mean that we can maybe claim from a credit insurance company in case there's a risk there? Because obviously our business can go under if the customer can't pay for all these beautiful laptops. The next question we have to ask ourselves is, who's going to do the credit control? Who's going to chase the customer? We have to ask ourselves, what happens if the customer doesn't pay? What do we do then? Pre-legal, kind of legal recoveries. That is exactly the issue that all our clients, I said to you in the intro, we have about 1,200 of them. That's about the sense of what our clients go through on a day-to-day basis. Now, it's easy enough to be able to answer some of those questions if you've got one customer. But some of our clients that we run, they literally have thousands of customers, and all those customers are situated in disparate parts of the world. They may be trading into South America, Europe, or obviously very much into Africa, exporting all over the place. And of course, there's even a financing component attached to that. Because now, how do you finance that whole process of being able to extend credit? Obviously, if the stock walks out the door, that means that you have to wait for your money until the customer pays you. So all those questions sit in our mind, and that's exactly what credit management is supposed to do: is to try and coordinate all those processes effectively, so that the company makes profit through each of those transactions and has very, very effective cash flow through each of those transactions. Go for me to the next slide, please, Linda. Yeah, so the purpose of credit management for SMEs is to establish a systematic approach to credit evaluation, risk mitigation, and debt collection. Those are some pretty cool words, but it really means, do I know who am I dealing with? Do I fully understand exactly what the risks are involved in the process, and can I actually collect my bucks? The issue with credit management is that the way that you really have to define it in your own head is the maximum amount of money outstanding for the shortest possible period of time, okay? And then to make sure that that customer comes back again for another experience. It's one thing to sell to a customer on a once-off basis. If you hassle the customer so much for his money and payment, etc., he's probably not going to come back to you. So it is about the maximum amount outstanding for the shortest possible period of time, and at the same time, you have to create a good customer experience. And that properly is the challenge of extending credit. What you must...
I'm so sorry, Frank,
yes,
please continue.
Thank you. Okay, cool. So what you need to understand about extending credit is that businesses have certain competitive advantages within their organization. And let's just go back to our laptop example. In our laptop environment, there will be certain competitive advantages that we may have over the opposition. We may have a better product. We may have better after-sales service. We may have a better pricing. In many businesses, it's also based about location that creates competitive advantages. Credit extension, credit management is a competitive advantage within a business. So to give you a really, really simple example so you can really understand what it is I'm talking about. In the old days when Edgar's was still, when Edgar's was still Edgar's or Edcon or however you want to put it, before they were bought over and sold and went into business rescue, you will remember that you could go to Edgar's and you could open an account for yourself, okay? Or alternatively, you could go to Woolworths, or you can open an account for yourself. And there were a couple of clothing stores around like that where you could go and open an account for yourself. Yet in South Africa, maybe just to tell you, now we all knew the Edgar's of past didn't necessarily have clothing that was the cheapest. They certainly didn't have clothing that was of the highest quality. But yet, somehow, Edgar's managed to have way more credit customers than any of those other retail stores that they were competing with at the time. One of my very good friends, a guy called Ian Wood, was the credit director at Edgar's when it was still prior to business rescue time. And at their peak, they were running 4 million debtors accounts, just over 4 million debtors accounts. And that is enormous for a population where even now we have about 23, 24 million active credit consumers within the South African market. How did they do it? Very simple. Using credit as a competitive advantage within their business. 6 months no interest or 12 months low interest. That was the mantra. And that created competitive advantage for them within the organization. Exactly in that same fashion, effective credit management can provide competitive advantage. If there were two of these laptop companies that we started right next door to each other, so no geographic location advantage, and we sold exactly the same laptop at exactly the same price, exactly the same quality, and exactly the same after-sales service with a beautiful customer experience both. But one of these companies offered 30-day terms, and the company next door to them, you could only buy from on a COD basis. Which do you think will be a growing empire, and which do you think will be dying? And that is the reason why companies sell on a credit basis. In fact, the only reason why we sell on a credit basis is to boost turnover. There was a company many years ago called Steel Giant that was a steel merchant, and they competed. The company was based in Randfontein, and they competed in that whole Joburg West kind of market. And they competed with the other steel merchants around in the area. And they tried to extend credit, but they got burned so many times by not getting the process right that eventually management got so fed up that they said, you know what, from now on, what we're going to do is we're going to purely just trade on a COD basis. And what do you think happened to the business? About a year later, they closed their doors because no one would want to buy from a company purely on a COD basis if they can buy from anywhere else in the market, getting 30-day credit terms. I hope that gives you a good indication of what the purpose of credit management is about. Go with me to the next slide, Linda. Okay, so on the left-hand side, what I've got for you here is what we call the credit management value chain. So before the existence of DebtSource, you basically had to go to many different disparate companies to be able to get this kind of the value chain going. So just quickly, what is a value chain? It kind of implies that there's an interdependence on each of these parts upon the other part. And that is the philosophy of DebtSource. We say that, listen, the way that you assess your debtors, the way that you credit control your debtors, the way that the data on debtors are managed are not different things. The way that you recover your debtors, the way that you have the staff and your credit policies within the process, they're not disparate things. They're all part of the same thing. And this is literally the itch that I had to scratch when I started the business 20 years ago. This philosophy is simple. These are all part of the same thing. The way that you extend credit should be the way that you finance your business, should be the way that your debtors are managed, should be how you insure your debtors, and should be how you recover the debtors. I mean, we love it in a credit control environment when the credit controllers get given the responsibility for collecting debtors. You guys must just shout if there's a question, okay?
Yes, please. You're talking a lot, but and we'll give I think what we'll do is we'll give the audience after this slide, Frank, an opportunity to maybe ask questions if they have any questions so far. Please continue.
Perfect. Okay, perfect. So yeah, coming back to the credit controllers, one of my favorite things is the credit controllers get given this responsibility to collect this debtors book. So what they've got in front of them is a ledger. They've got 200 or 400 debtors on this ledger. The target is 100 million rand that they have to collect this month. And then what happens is that they don't reach the target and they get beaten, right? They get downgraded, performance score, KPIs, bonuses, all the consequences you can possibly imagine. And that then happens, that potentially then happens kind of month after month after month. But the real problem is that together with that responsibility needs to come the authority. In other words, what I'm saying, someone else in a very different office, somewhere along the line, sometimes even in the sales department, is sitting there saying, oh, we're going to take on this customer, we're going to take on this customer, we're going to take on this customer, we're going to take. And it's almost as if credit control becomes a consequence of the sales process. Okay, not a carefully thought through strategy that says, listen, people, if we want to try and collect 100 million rand from these debtors today, this month, maybe what we should do is we should carefully select who we bring onto that age analysis. And so often when credit control, we talk about responsibility and we talk about authority at the same time. And that is why, just as an example of the credit management value chain, how the credit information stuff sits very, very closely aligned with the credit control component. Credit management is the main source of financing within any business. The credit that you get from your suppliers is the main form of financing within your business. When we talk about financing, often companies think, oh, I got to go to the bank for an overdraft facility for the company does 100 million rand turnover and has R1 million overdraft facility. That's not financing. Financing, theoretically, for those of you who are properly financially minded, the amount of trade credit that you're using as financing within your business is the difference between your account receivables and your account payables. That is the form of financing. The kind of financing that you get from your suppliers is financing into the business. The kind of financing that you provide back to your customers is the financing that they obtain within the business. And it allows this trade cycle to flow very, very quickly, instead of all of us having to wait until we've got cash in the bank to be able to do the next transaction. I'm just quickly going to touch on the 4 main forms of credit. So maybe you just understand exactly what trade credit means. So the 4 main forms of credit, the first one is sovereign credit, country risk credit. This is where countries borrow money from primarily the World Bank and sometimes from each other as well. Here you will have rating agencies. You'll often hear that South Africa's rating has been upgraded, downgraded, etc. And there's companies such as Standard & Poor and Fitch's, etc. that do those rating agencies. I want you to think of those rating agencies as credit bureaus for countries. If the countries start falling out the tree and they can't repay their debt, then they go to the IMF. The International Monetary Fund will give them a loan, but what the International Monetary Fund also does, it provides them kind of the Archer inspirations, coaching component to say, but hang on, we could give you a loan, but you need to fix the following stuff. So that's what the IMF does. It's almost like a business rescue practitioner for countries. Okay, that's the way to think about it. So that's the first main form of credit, that's sovereign credit. The second form of credit is banking credit. These are determined by longer term transactions. So you don't go to a bank because you want to borrow 100 rand and repay it in a month's time. That's micro lending, all those other stuff. You go to a bank because you're hoping to engage in a long-term form of credit. These are typically mortgage bonds. Even overdraft facilities are long-term forms of credit. The bank doesn't give you an overdraft facility now and pulls it again in a month's time, not unless there's seriously adverse stuff going on. They basically review the facility on an annual basis. So it's a longer form of credit. And usually if they withdraw an overdraft facility for a company, they could force the company to close down. So they have to be very careful about that because it's a long form of credit. Obviously, vehicle finance, there are lots of other personal loans, all that kind of stuff. Banking form of credit. Debt source does nothing from a banking credit. Obviously, we do nothing from a sovereign credit. The third main form is what we call consumer credit. So this is exactly the example I gave you early on Edgar's typical consumer credit. These days, personal loans also sometimes get pushed into consumer credit stuff. There, it's just the volumes game. You're not really concerned about the individual, mainly because the transaction values are so low. So typically, the transaction values in a consumer credit environment the average is about 15,000 Rand. Give you an idea, furniture accounts, clothing, retail stores, all that kind of stuff. Whereas in a trade credit environment, the average account size that we deal with sits at just over R1 million. So often we get told, but you can just do a scoring system and the scoring system can tell you exactly what it is that you need to do. I mean, if Edgar's can do it, like the main difference, and that is what the fourth main form of credit is, the thing called trade credit management. Short-term credit transactions, usually 30, 60 days. Sometimes it can be 7 days if you deal with perishable goods, but it can also be sometimes up to 360 days if you're granting credit to a company that's building a road, or think about a company that builds furniture. Then you need 180 days worth of credit because he needs time to build that furniture and sell the thing before hopefully he has to repay you. And so that's what trade credit is. This is a higher value transactions. You can't just apply some sort of a scoring model to the process. You have to look at every debtor individually. If you lose that 1 million rand customer, then that theoretically means 6 million rand a year in sales to your business that you will lose. At a GP of 20%, you can start working the numbers out for yourself. So each and every customer has to be carefully considered. You have to also make sure that that careful consideration doesn't turn into a bad debt, and that it also affects your cash flow in a positive way. Of course, these days, data management is credit management. If you cannot manage the data within a business, if you're not sure where the customer's credit application form is, if you're not sure where the POD is that was given to the customer that he signed for when you delivered the goods, if you're not sure exactly where all the pieces of the puzzle sit, you're in deep, deep trouble. You try and sue a company when you don't have a proof of delivery. These days, you try and sue a company if you've got a dodgy credit application form or a credit agreement, you're kind of in trouble. And of course, more and more, we've got the regulatory environment that comes in. How are you managing my information? Have you got consent from me to do so? What is going to happen if I don't pay you? Are you allowed to report me to a bureau? Can you use an insurance company to check out my information? What are my financials confidential? What will happen to my account if I no longer use you? That's all poppy stuff. FICA stuff, of course, every company that extends credit has to register with the Financial Intelligence Center, irrespective of what form of credit you're granting, whether it's to 5,000 consumers, 5 million consumers, or one debtor, one commercial debtor. You still have to register with a FIC. That's probably a session for a whole nother time as well, but I'm happy to take questions on that if you want. And then, of course, all the credit transactions that you do are governed by the National Credit Act. Doesn't necessarily mean that in commercial credit you have to register as a credit provider, but the regulatory environment certainly becoming more and more intense for us to manage. And that's, of course, a big part of what DebtSource also does as a quick punt to help our customers manage that process. I'm ready to take a question and a sip of water.
Thank you very much for that, Frank. And that was really a mouthful. And I mean, my mind is full of questions, but of course, this is part of what I do in my role, in a finance role. But if anybody wants to ask a question now, maybe just if you need to just clarify something or want to ask something particularly, you're most welcome to raise your hand and ask the question. Anybody? Not right now.
Right.
Yeah, I have a question for Frank, please.
Okay, sure. And I see Debbie has raised her hand.
So, Frank, let's assume that I have a client who's got a business that has a 20 million rand a year turnover, and they've realized that there is an opportunity to grow the business by 20 or 25% if they offer credit for the kind of services or product that they sell. How do they go about costing that credit into the business? Because everything that you've said now makes sense, and you can attract a greater market share, and you can do all of that, and you can manage the risk and put the processes and all the rest. But that comes at a cost of insurance, that comes at a cost of administration, that comes at a cost of humans, that comes at a cost of whatever, which directly impacts on the price of the product to the consumer, because that cost has to be found somewhere. So what's the rule of thumb around that?
Yeah, it's a really great question. How do you calculate the cost of credit? So the cost of credit is calculated as inflation rate plus the interest rate, okay, plus opportunity cost. So in other words, because inflation devalues money, 100,000. If the inflation is 10%, it basically means that 100,000 rand will be worth 10% less at the end of the year. So it's the inflation rate, and if you then so it's inflation rate plus the interest rate plus opportunity cost. If you calculate that out, roughly you get to somewhere close to about 2% per month. In other words, if you're used to selling something at a certain price on 30 days credit, you need to add an additional 2%.
Got you. Thank you. Thanks.
Debbie,
I think there
your
was another
question?
Yes. Okay, Frank, your whole presentation is about how it's good to have or to. Sorry, I'm not a financial person, but it's good to have clients on credit. Okay. Now, in our industry, being the travel industry, we don't work on credit at all. Our suppliers want payment before the transaction. The airlines want payment. Everybody wants payment. So for us to go and provide a client with credit puts us out of pocket hugely, because we're still having to pay at the time of the transaction. I mean, I know most travel agencies, obviously not so much the bigger ones, but the smaller ones definitely. We've all had to go on a, payment, upfront payment by credit card basis. How do you feel about that in our type of industry?
So Debbie, tell me first of all, do you deal with consumers or do you deal with businesses exclusively?
Okay, so now I'm going to act really blunt. What's the difference?
Okay, do you deal with no, do you deal with private individuals or do you deal with companies? So would you deal with debtors or would you deal with a private individual? Both.
I would deal with both, the private individual and corporate companies.
Okay, so in the case of private individuals, don't offer credit terms. Those private individuals will use a credit card if they need credit terms, and then through Visa, Mastercard, that kind of stuff. And then through that process, they get credit facilities. Also, extending travel finance in a consumer environment, there are very few models where I've seen it work, and certainly not in South Africa. So it's not recommended, and you're going to lose money. So don't do that in the consumer environment. You also have to register as a credit provider in terms of the National Credit Act. So that comes with a massive compliance component if you're trying to extend credit to private individuals. So the short answer is don't do that thing. When it comes to extending credit to businesses, where the legal entity is a closed corporation, private company, or a public company, you will find that most of your business clients, one of the first questions they will ask you in your introductory meeting is, please, will you give me a 30-day account? We, for instance, have a travel agency, a debt source that we work together with. And part of the reason we work with them is because they give us a 30-day account. So that we don't have to be in the cycle the whole time. We're having to pay up front, and it just messes with our administrative processes. What you need to do, exactly relating to the question that we had asked, that was asked a little bit earlier, what you need to do is you need to take a normal price, you need to add at least 2, maybe 2.5%, even a little bit more if you want to. Okay, go up to even 5% if you need to. And then you are able to offer credit extension, okay? And then you must just make absolutely sure that your processes in the background, kind of more or less the credit management value chain that I'm talking about here, that you're following those processes. And if you struggle with implementing those processes, you'll be happy to know in the market there's a company called DebtSource that can help you with that. Sorry.
Okay.
Okay. But just let me just give you a glimpse of what that opportunity is. If you're going to try and sell to businesses, if you're going to sell travel solutions to businesses, and you're not going to offer them credit terms, you're going to struggle to get into companies. If, however, you do open it up from a credit terms perspective and you pick your targets, we're not talking about dealing with subpar debtors here. We're talking about dealing with decent debtors. Then your business will grow exponentially because of it. And there's a good possibility that your profitability will also grow as a result of it.
Okay. All right. Perfect.
Frank,
Thank you very much.
If I can jump into it, and I've just had this conversation a couple of weeks ago with one of my clients who does private or to the individual and has started playing a lot into the larger corporate industries. And obviously the larger corporates are now requesting credit and longer payment terms, etc., and all of that. And it's really good. Bear in mind, well, who are you targeting? Because if you're targeting the corporates, you're going to have some form of credit terms behind you. If you're targeting the individuals, well, then that's a different story. They can pay on the damn credit cards. But the challenge is when you're targeting both, how do you differentiate with your pricing? Okay, so that's when it becomes a very fine line. And yeah, I'll recommend it to my client. Outsource the credit terms. Go to a credit company that does the credit. So your pricing remains the same. They are paying credit terms with the credit provider. That makes more sense.
Yeah. Look, I've got some big corporates, but they all work on a credit card basis, which is perfect.
Yeah.
But then obviously there are other clients who do want an account. And it becomes difficult because the bigger the clients are, the bigger your cash flow needs to be, or your overdraft needs to be, you know?
I came out of a corporate world, okay, where, Grant, you're going to chuckle, okay. We used everybody else's money to finance our money. So we never had to use ours. So we took from Peter to pay Paul, and Paul then in turn paid John, and John in turn paid Paul. And we never had to touch our money, and we just made the money on the sideline. It's how they work, it's how they operate. So some of the larger companies, their whole intention, excuse me if I offend anybody here, is to screw the smaller people over and the individual companies over. Okay? So protect yourself all the time. If somebody only wants to do business with you in credit terms, get the help of somebody who understands credit. Talk to people like Frank. Otherwise, don't go into credit at all. Play in a different field. You don't play soccer on a rugby field. You can't go playing rugby on an ice rink. Play in the game that you know and you understand.
Thanks, guys.
Yeah, absolutely. And you know, one of the biggest things of when you decide to make that move and actually extend credit, and apart from the regulatory side, I mean, it's not only about, you know, I'm extending credit and my cash flow and everything else. It's about, it starts right at that beginning when I want to vet my customer. You know, can my customer actually afford to be extended credit? Can my customer actually afford to make use of my services? On our audience today, we have participants that are bursars at schools. And one of the things that I always say well, just go back, you know, Frank, in the beginning you said there's always this thing about sales and credit management. So at the school it's about admissions and can the parents actually afford to pay? And I mean, the whole process at the end of the day starts with, you know, what can my customer actually, you know, will it be a good customer? Because otherwise I would be at risk. If you would like to add something to that, Frank, or are we going to go on I think on one or two of the other slides further, we'll talk a little bit about vetting, eh?
I just quickly want to touch on the subject of extending credit, from a school environment, or rather having parents pay kind of as they go along over 10 months or whatever. It's quite a unique form of credit in a way. Obviously, there is potential for credit risk, and it's interesting how people sometimes prioritize school fees before they prioritize other stuff. And of course, there's also the opportunity cost. So it's one of our clients, for instance, is the South African Broadcasting Corporation. And it's interesting if they say no to you, okay, to place an advert on one of their radio stations, theoretically, the radio station still broadcasts. So whether your advert is there or not, I haven't actually lost anything. Do you understand what it is I'm coming to? So there's and some of the schooling guys actually take some of that same approach as well. And typically you find that the bad debt ratios there are kind of quite low, but it does sit in the field of business to consumer credit as well, and it can be difficult to manage depending on which sector of the market that you're working with. I think maybe just to move on from what I've said to you so far, the next 3 slides, what I'm going to try and do is I'm just going to try and give you like the key objectives of credit management. So in the introduction, and when I showed you the value chain, there's lots of concepts which I introduced and probably, jumbled it all up in your head. And my apologies for that, but I wanted to give you like the high level view of it. So what we're going to do for the next 3 slides is we're just going to give you like, what are the key objectives? I'm really going to try and break it down for you. Do this, do proper simplistic stuff. And if there's anything, if I'm talking over your head or any of that stuff, stop me immediately and say, okay, what does that actually mean? And I hope that comment doesn't sound condescending. Go first to the next slide, please, Linda.
Okay. And I think, Frank, I'm going to let you then, talk to the slide, but when we just look at it and for us that is in the finance environment and looking at cash flow, if I just look at those headlines, minimize bad debts, optimize cash flow, improve profitability. And then I think something that people often forget is, the enhancing of relationships. What does that extending of credit actually mean? And is there actually an advantage other than a financial advantage? And please take us then through, a little bit more detail of the key objectives of credit management, Frank.
Okay, so some of the key objectives. Some companies start off by making the key objective turnover growth, and turnover is a very vain thing. I mean, it's in credit terms we always say that turnover is vanity, profit is sanity, but cash flow is reality. In other words, if you're going to implement a whole credit process, or you've already got a credit process that you've implemented, but it's not improving your cash flow, it's not improving your profitability, and it's only driving your turnover, then that's not going to really meet any of your true business objectives. And so the thing that you've got to do is you've got to use credit to optimize, to minimize bad debt. So that's like one thing you've got to avoid. You've got to say, okay, I expect that my bad debt write-off is, let's say, 0.1% of sales. So just tell you that 0.1% is not a number I suck out of my thumb. We do about 7,000 reviews on companies per month at DebtSource. So I think about 80, 90,000 per year. And I'm talking about financial statements assessments. And we know exactly what the delinquency rate is in those credit limit recommendations that we do to our customers. And on average, our customers will have a delinquency rate of 0.11% as at the end of September. I don't yet have the October number. So roughly about 0.11% of sales. What you've got to achieve within the process, though, is just minimize those bad debts. So that really just speaks to picking the right customers. You can come to DebtSource. There are credit bureaus around. There are quite a few solutions just to minimize bad debts. Of course, we look at the thing holistically, but if you just want to minimize bad debts, then it's effective information that you need. You've got to optimize the cash flow through the process by just carefully considering your debtors days. That cost of credit calculation discussion that we had earlier on is a critical component to getting cash flow right. If you sell for the same price on credit as you do for cash, you're going to see a profit margin squeeze. No, absolutely no doubt about it. It has to improve your profitability. And of course, it has to enhance your customer relationship. If granting credit to the customer worsens your relationship, then, again, you're not meeting the business objectives. So just kind of very, very simplistic. These are the key objectives of credit management. Try not to pick up bad debts. Remember, it has to improve your cash flow. And remember, it has to improve your profitability, and it has to enhance your customer your relationship with your customer. Key to that. Components of credit management. Go with me to the next slide.
There we are, Frank.
Thank you so much. Okay, so credit evaluation is critical when you're extending credit. So So, I mean, if we go back to my example that I gave you earlier on of these laptops that we imported from China and that we built this business around selling laptops, you will agree with me that R1 million in laptops doesn't really get you far. Those laptops cost 20,000 Rand a piece, so that's 5 laptops for 100,000 times 10. It's basically 50 laptops. And for companies who trade in laptops or sell or distribute laptops, it's $1 million. It's not a lot of money. So imagine the process that you would have to go through in your business if you had to approach the bank tomorrow and say, guys, I need R1 million overdraft facility. Just think about the forms you would have to fill in, the information that you have to do, maybe even the securities that you have to provide, personal sureties, bonds, all that kind of stuff, and the reference checking that the bank would do to give you that R1 million. Yet in trade credit, we often give away loads of credit without doing proper thorough analysis on that business. The analysis does not have to take long. So on average here at DebtSource, what we do is it takes us somewhere between 1 day and 5 days to do a credit evaluation, depending on the amount of credit. If our customer's debtor needs 100,000 Rand facility with 24 hours is more than fine. If it's a 20 million Rand facility, there's an escalation process. And of course, that's based on the fact that we've got the correct information. And we suck information from bureaus, and we look at financial statements, and we do reference checks and all that kind of stuff. And it's a critical component to getting credit right. If you're not currently doing credit evaluation and you are extending credit, it's just a question of time before you're going to have a bad debt and possibly fraud. If you're not doing it on an annual basis, because remember, your bad debts will never come from, well, your bad debts very seldom come from the guy who's just opened an account and can't pay within the first 3 months. It comes from the debtor you've been trading with for the last 10 years, and you thought, but he's paying fine. Why do I need to worry about him? Annual evaluations need to be done. And in between, you need to also do the credit monitoring, which we'll come back to in a minute. You need to have a credit policy. Again, going back to that example of the laptops that I told you about. If you're starting out in credit, or even if you're currently extending credit, you need to be clear about what your policies are. You need to be able to communicate this clearly to customers, and you need to be able to communicate clearly to customers. You need to be able to clearly communicate that to your staff. You need to be able to clearly, there must be, kind of think about it as a blueprint, or even better, just guys, we all need to sing from the same hymn sheet when it comes to what terms are we going to offer, when are we going to put the customer on stop supply, who has to approve kind of what credit facility. We don't like long, big credit policies, because what's the point of putting a policy in place when you don't live it? It can be a 2-page document if you so want it to be, or a 1-page document. Sometimes we laminate a 1-page summary of the credit policy and we give it to the sales guys when there's lots of debtors on the debtors book, or the people at the branches, or the credit controllers, and say, this is the credit policy. This is how we extend credit within this organization. The credit monitoring is really, really important. Things change on businesses all the time. Companies who were fine yesterday are not fine today. We manage so many pre-legal and legal files, and things go wrong within businesses. And it's therefore critical that debtors are monitored. It really, really is critical that they are monitored. And so in between your annual reviews on customers, you need to monitor those debtors. And there are a couple of monitoring solutions available in the market. And of course, we can also help you from a DebtSource perspective. A monitoring solution basically is, if something happens with a debtor, all of a sudden SARS takes out the judgment because the guys haven't paid their VAT, or one of the directors gets judgments in their personal capacity, then we immediately let you know that there's a problem, and you need to just quickly go and have a reevaluation on the customer's credit limit and credit facility. There were comments earlier on about selling to friends and family, or the comment earlier on as well about that someone posted about, I know him so well, he must pay me. At the moment, one of our clients phone us up and say, listen, we've got this customer, he's a great friend of the MD, can we give him credit facilities? Like, everyone has to go through exactly the same process. At the moment you start doing favors in terms of giving money out, you can imagine how that would end for banks. And it's not different. When you extend credit, you're running a little mini bank. Exactly, it was said earlier on. You're using other people's money to help you make more profit within the process to grow your turnover. And so you've got to make sure that everyone goes through that same process, which is why credit policies are so critical. And then finally, just the debt collection. Make sure you've got some effective debt collection. Who's going to phone for the money? When do you put the guy on stop supply? When do you escalate it maybe to a third party to be able to recover the debt? All that kind of stuff is really important. And what happens if the customer still doesn't pay? Do we have an attorney on standby that we can, issue summonses and do all that kind of stuff? Those are the key elements of getting credit management right. Should we go to the next slide, Linda?
My buttons doesn't want to work today. Please go ahead, Frank.
Thank you very much. Yeah, so just kind of best practices for SMEs. You've got to conduct comprehensive credit checks. It's exactly what I said to you earlier on. You've got to establish creditworthiness, and you've got to try to identify potential risks. So just to give you another scary statistic from the number of reviews that we do, I told you earlier on that we do about 67,000 reviews on a monthly basis on companies. About 1 in 300 of the reviews that we do has got an element of fraud attached to it. That is scary, people. One of the easiest ways to defraud companies is to apply for credit facilities from them. It's a separate conversation altogether, so we won't go into it, but you've got to completely understand who it is that you're dealing with. Establish and enforce clear policies. You must have a credit limit on a customer. Just as much as your bank won't give you an unlimited overdraft facility, or just as much as the ATM won't allow you to withdraw, as much money as you like at any point in time, you can't have, there are very few companies that we genuinely call blue chip in this day and age that wouldn't need a credit limit. Establish a credit limit. What is the risk that you're prepared to take on that customer? And that is the credit facility that you should implement. You've got to regularly review and update your credit terms. Financial changes, obviously, when market conditions, the example that we were given earlier on of the travel industry and how things changed during COVID time, it was terrible for those travel companies. All of a sudden, no one could pay. All of a sudden, no one wanted to pay. All of a sudden, you saw everything just being placed on ice. It had a massive, massive impact on the business, and clearly that has to affect your credit policies and your preparedness and willingness to extend credit facilities. Implement robust invoicing systems and follow up promptly on overdue payments is also an important component of credit extension. You've got to make sure that you're sending the right documentation and you're sending it as quickly as possible. And then you've got to monitor the cash flow, the debtors days, and everything that goes with it. And then you have to really, really try and still maintain good, transparent customer relationships with open communication and fair credit management practices. Mr. Customer, when you apply for credit facilities, we are going to do a credit check on your business, and you have to provide us with financial statements. If that's what your policy is, then that is your policy. Tell it to the customer upfront so that there's no expectations of you're just going to give me credit and you don't have to check me out at all. Let's go to the next slide, please, Linda. Kind of from a conclusion, perhaps a summary perspective, just to say to you that it plays a critical role in the financial stability and growth of SMEs. It's even more, credit management's even more important to SMEs than it is to big companies. If a big company that is listed on the stock exchange suffers a 10 million rand bad debt, I can promise you that they probably are going to survive. 10 million rand will hurt them, but they're not going to fall out of the tree. If your small business suffers 100,000 rand bad debt or a 200,000 rand bad debt, that may mean that you're not taking a salary for 3 months, or in some cases it does mean that actually businesses fall out the tree. They go into business rescue liquidation simply because their customers cannot pay them. So that you really have to try and avoid. But it's not this process which is absolutely impossible. By implementing some basic logical There's no science behind it. It's not that complicated. It's just a process. Get the customer to sign a credit application form, check them out, monitor the data, phone for the money. The moment you have a problem, get a professional involved. That's how simple this thing can be. And of course, so try not to overcomplicate this thing in your head and think to yourself, oh, well, credit management is so complicated, there's no ways I'd be able to. It's not that. You can trade into some unbelievable markets. We have got models here that we've worked with customers that sell into the shebeen market, people, and get paid very successfully and make huge profits with minimal bad debts within that process. So anything is manageable from a credit risk perspective. I think a systematic, proactive approach to ensure long-term success is critical. And if you've got that mindset, it will be successful.
Fantastic, Frank, and what a fascinating presentation. You think you know everything about credit management, but having listened to you again today, it makes, I mean, obviously numbers is my thing, but it makes me so excited, just to know that, and Kenny will always talk about follow the process. So Kenny, right up our alley, following the process, because when we follow the process, our finances flow to there where it needs to go. So thank you very, very much for everybody's attendance, and the floor is open if there is any more questions. We've still got a few minutes left, so if anybody would like to know a little bit more or ask a question, you are most welcome to. Please raise your hand. Are you all comfortable that you have a good overview and understanding of credit management now?
Not a question, Linda, not a question, but just a comment. I found this incredibly interesting and all just really so simple. And I think there's a lot of people that don't actually know about, even if you've got one person you're giving credit to, that you've got to be registered to do this. It's very, very interesting. Thanks, Frank. Really enjoyed it.
Pleasure. Yeah. No, it's a fascinating field, and I so love your comment about the fact that it can be simple. I think if you overcomplicate it in your mind, then it can be complicated. Look, I mean, to be fair, I mean, some of the credit management strategies that we implement, help our customers implement, can be enormously complex for 1,000 different reasons. But if you just follow the basics of some of the indications that we gave you today, generally speaking, you're going to be fine. And please, I mean, even though I do say a punt for debts, also reach out. If you come unstuck 3-6 months from now, reach out to Linda. Feel free to reach out to myself. We will always be very, very pleased to help fellow entrepreneurs. And Linda sometimes doesn't even charge for it.
Yeah, no, definitely, because advice, we all can always give advice. Of course, when it gets more complex, it's different. But I mean, advice, and I think that is what so, Frank and I absolutely complement each other. And if I may say that, the same with Kenny. He is so generous with his assistance and advice, because it's not always about money and making money. It's really about helping the fellow entrepreneur and the fellow business to really go and make a success of their business. So thank you again, Frank, very, very much for your contribution today. And I'm going to open the floor one more last time before we share our contact details. Any other questions or anything that you would like to add, Kenny?
From my side, no. Just thank you, Frank, for your time and adding to it. And yeah, you jogged a lot of memories from my past, where similar type of things have been there, and you always forget stuff you've learned until something reminds you again. So thank you very much, Frank, and well done, Linda.
Thank you very much, Kenny. So I think then that all that is left is there is Frank's details. You are most welcome to take it down. There's my own details. And of course, when you do go to our website at Arts for Inspiration, all our other coaches' details are there as well. You are most welcome to also reach out to any one of them, whether it's about managing your credit management, about managing your cash flow, or anything else around your business and coaching that you require. Please do not hesitate to reach out to us and we will gladly assist. And Frank, then on that note, again, thank you very much. I really, really appreciate the time that you took today to come and speak to us. And even I have learned one or two things extra. I mean, I was amazed, when you say that 1 out of 300 applications is actually fraudulent application. I didn't realize that it's actually so much, which makes me as a finance person just that little bit tad nervous the next time I review a credit application.
Thank you so much, Linda. It was an absolute pleasure and, may I say, a privilege to be with you guys. And yeah, just from my side, if there's ever anything that you struggle with, a customer that's not paying you, you're in a difficult situation, you don't know what to do to any of the participants, please reach out. We'd love to help.